All right, guys. So I've been getting asked when is the next housing market crash, and I'm going to let you know right now up front. I do not know, but there is a couple of factors that I am watching for in the general economy that could set it up. And again, these are just my personal opinions, and I'm going to go over a couple data points to help relay that to you guys. Now, before we jump into these articles right here, or these data points, excuse me. Thanks for supporting my channel. My name is Joshua. I'm a realtor here in the Sacramento and surrounding. Okay, so this is from SacramentoAppraisalBlog.com. We're not going to go through the entire article right now, but this is his latest article, which was the spiking housing supply and fewer buyers. Now, I just want to touch on this point real quick. The spike in housing supply is not due to the sellers, and it's very easy to pin this on the sellers rushing to list, but that is just not the case. This is actually about fewer buyers getting into contract, and we've seen close to 2,000 fewer sales in May, which means listings that normally would have sold are still sitting on the marketplace. In other words, the spike in supply is coming from a weakening demand rather than for more listings hitting the marketplace. And you can see on this graph, which is pretty substantial, is going back for the past 8 years or so, we have not seen such a massive spike like we see right here. I mean, it's like 88-degree vertical jump, and the length of it, we haven't seen anything like this in the past 8 years. So this is very, very interesting. And to support this data, this is the Sacramento region new listings and pendings, and you can see the new listings were right about even of 2020 and 2021. We're slightly below what we saw in 2019, 2018. So it's definitely not a spike in new listings, but right here, so you could just see right here, I mean, the volume is dropping pretty good. I mean, it's I mean, just look at it. It's good. This chart right here should say it all for everybody watching this video. And so for me, what I am seeing, or what I'm watching for, I'll say it this way, what I'm watching for to lead up to a housing market crash is going to be the labor market. Now, we got a little article here we're going to touch on in a minute, but the labor market is the wage, for me, is the wage growth. You know, seeing wages continue to grow, especially with inflation, that's always huge, as well as the layoffs and consumers being done purchasing goods and services at these. Whenever we start rejecting these prices, companies are going to start to revert to the highest cost item, and that's always an employee. So you can see how this becomes like a circle, like a circle, right? You know, the consumers get fed up with all the high prices. They can't afford the basic necessities like food, energy, and housing, right? Housing. And once that happens, they have to have those three items because those are staples. Once the consumer has all their money focused to those, they can't go and spend money on the Netflix, the new iPhones, the new cars, right? Those even everything's jumped up in price. So what do these big companies do that have such huge market share of employment? Well, they start laying off people because people are always the highest cost item in a business, and they're always the first to go, which leads me into this little article here from Fortune magazine. And the tech industry's massive 2002 layoffs are a sign of a boomerang effect. Now, this is a LinkedIn economist that said, and so far in 2010, or the 2010s was a booming decade for the tech sector, but so far in 2022, it has been the year of the bust that has dragged the industry back down to earth. Now, amid a larger market downturn this spring, the tech stocks have suffered the worst rout and massive waves of layoff. As of July, there was 30,000 U.S. tech workers that have been laid off, according to an analyst at Crunchbase, and there is more even expected. If you're into the stock market, which I'm sure everybody's been in the stock market these days, all these big time companies are beginning to lay off 10, maybe 20% of their workforce each quarter, right? And they don't say they're going to lay off another 10 or 20% next quarter, but the trend, if you go back through all the earnings, that's been the trend. They haven't done. They did it like 5%. Some did 10% last quarter for their earnings reports, and majority of them just did some type of hiring freeze with a combination of layoffs of 10%. So if we continue to see this going into next quarter, expect to see more, and that number will probably jump up to $60,000 or $90,000, which doesn't seem, or not dollars, but layoffs, which doesn't seem like a lot, but you compound that with multiple industries getting into it, consumers continuing to not purchase these goods and services, is going to lead to more and quicker and deeper layoffs than we would like. So if we get back into it, this is the wage growth tracker, and this is from the Economic Policy Institute, and they do a good job because they have a hypothetical assuming a 3.5% growth level, and this is on the dotted line that you can see here. And this hypothetical, assuming a 3.5 growth, actually comes from the Federal Reserve Board's 2% inflation target that they want each year, plus a 1.5% in productivity growth in our labor market, as well as stable labor share of income. So that's where this hypothetical 3.5% growth comes into play. And here in that blue or black line, this is actually what we've had. So since 2007's financial crisis, we have yet to perform at that hypothetical level ever. And it continues to get wider and wider. We actually got a little bit closer to it, but all this stimulus kind of pushed it up. So as the months continue, or as the data continues to come out in the months ahead, if this gets wider and wider, this is going to solidify what I am thinking about as far as the next housing crisis is going to be the wages and the layoffs. So over to this next graph, this is the house price index for the United States here in red with the employed full-time median usual weekly real earnings. Now, real is inflation adjusted, and you can see whenever the housing market is elevated quite high, wages are down low, and you could just see the correlation. But if we move into present day, we had housing come down a little bit, wages spiked up, and then we had the reverse happen with here in red again. Remember that these are the home prices have spiked up hard. They came down a little bit and looking to stable off, but the wage growth has continued to come down. Now, those are my factors I'm looking at that's going to potentially lead to a housing market crash is the wage growth. And on top of that, the amount of layoffs that are coming due to consumers not having any money to spend on these goods such as iPhones, new cars, and basically all the discretionary items and only the staple items, which are food, energy, which is gas, and housing. That's what everybody can only afford now, and that's really going to put a damper onto the economy. So that's my forecast in a nutshell. Hope you guys liked it. I'll talk to you guys soon.